I think I've sent the last handout with the theory. If you're very keen, can you confirm that the handout is there? Just confirm that is the last handout that carries the theories that we need to discuss. Have I forwarded the handout for the theory? For those theory, just confirm if that handout is there. So you say, okay, perfect. So then we say that we start with the tax systems. We'll start with the tax systems. These 2 days will be enough, then we're done. And what informs our opinion? I told you that with the syllabus change, we saw a lot of theory coming. So we just discussed so that we'll be in a good position. So when you talk about a tax system, we basically call it a structured way in which the government collect taxes from the taxpayer. So we basically call it a structured way, So whenever we talk about tax system, we call it a structured way. We call it a structured way, and we call it in which we say the government, and we say collect what's called the taxes from what I call the taxpayers. So when you talk about a structure, so when you talk about the tax system, we basically call it a structured way in which the government basically collect. Ngetich, thank you so much for showing up. Thank you so much for showing up. So we call it a structured way in which the government collect taxes, and we call it from the taxpayer. And usually, how do we usually support it by? Policies. This is supported by policies. Usually supported by, we have policies, and what's called regulations. Supported by what's called policies and regulations. So usually supported by the policies and regulations. Are we together? Tax reforms and modernization. Policies, regulation, tax reforms, and what's called modernization. Modernization. So that is what we call a tax system. That is a structured way in which the government collects taxes and is supported by policies, what we call regulations, tax reforms, and modernization. That is what we call a tax system. So then we proceed to the types of tax systems that we have. Types of what we call of the tax systems. Types of what we call the tax systems. Types of what we call the tax system. So we proceed to what we call the types of what we call the tax system. So in Kenya, we basically have 2 types of tax system. So one is what we call a single. We call it a single stroke what we call a single stroke what we call unified tax system. So we call it single stroke what we call unified tax, and we call it tax system. And then we have second, what we call the multiple tax system. So we have what we call a single stroke what we call unified tax system, and then we have what we call a multiple tax system. We respond with a yes. So then we start with what's called the single. We call it the single tax systems. We call it the single tax systems. So whenever we talk about single tax system, we say that the government basically uses one form of tax to collect taxes from taxpayers. So we call it one form of what we call tax to do what? To collect what we call taxes, and you say from what we call from the taxpayers. One form of tax to collect what we call taxes from the taxpayer, whichever. So the government can basically use what we call income tax, e.g., we can say the government the government can use only what you call income tax as the only source, of what you call taxes. That's a single tax system. A scenario where the government can use one form, for example, the government can use income tax as the only way of collecting taxes altogether. So then we proceed to the advantages. Advantages. We have on one end advantages, then we have disadvantages. So what are the advantages of a single tax system? When the government uses only one form of tax as the means of collecting tax, simple to understand. Are we together? Simple to understand. Simple to do what? To understand. That is one of the advantages of a single tax system. Simple to understand. Then easy to implement. We have it as easy to do what? To implement. Easy to implement. Then again, the cost of implementation is also less cost to implement. We can talk about less cost to do what? To implement. We have what we call less cost to implement. Less cost to implement. Those are the advantage of a single tax system. But one of the dangers, as a disadvantage, one of the dangers of a single tax system is basically insufficient tax. One of the reasons why we keep on expanding the tax is because if we have maybe a single tax, we may not generate enough tax. So insufficient tax revenue, we call it insufficient tax revenue. Tax revenue, we say for the government. Insufficient tax revenue for the government as one of the dangers of this form of tax regime. Then it encourages tax evasion. If you evade one tax, then you cannot easily. It encourages what we call the tax evasion. It does encourage what we call the tax evasion. So this one can basically encourage what we call the tax evasion. It does encourage what we call tax evasion. Together, it does encourage what we call the tax evasion. So then we talk about multiple tax system. The next talk about multiple tax system. I hope we're together. Multiple tax systems. Together. If you're together, we respond with yes. So we talk about what we call the multiple tax system. So whenever we talk about multiple taxing system, so the government introduced, the word is just, we just put several taxes. There are several taxes that the government introduced. So the government basically introduced what we call the several taxes at the same time. Several taxes, and you say at the same time. At the same time. So we can have the income tax, we have the VAT, we have custom duty, we have excess duty. So we have income tax, e.g. We can just say e.g. income tax. We have VAT. We have excise duty. We have excess duty, etc. to collect what we call the tax revenue. To basically collect what we call the tax revenue. So there are several taxes that the government basically introduced to collect what we call the tax revenue. So then I also want to talk about advantages of this regime. We have its advantages. And on the other hand, we talk about disadvantages, which are disadvantages. So on the advantages, put them down, we understand that the government, one of the biggest advantages that the government basically normally raise enough tax revenue. So the government is able to raise enough tax revenue. Enough tax revenue, we say is generated. So enough tax revenue, we basically understand that is generated. Enough, that this one discourages evasion. We call it discourages evasion. In terms of tax system, this is the question that came the latest. on disadvantages. So disadvantages of this, it is difficult to understand by a common person. When we have variety, difficult to understand, the word is understand by a common person. By a common person. So difficult to understand by whom? By a common person. And we must agree, Tim, that even today, the people still don't understand some other forms of taxes. Is it true, Tabla, that majority of people who still do not understand what you call other forms of taxes? So when, you know, the people who have obligations that even they're not even aware of, are we together? They say difficult to implement together. When you have a variety of taxes, difficult to implement. Difficult to implement. We can talk about difficult to do what? To implement. Implement. Then we can say costly to do what? To implement. Costly to implement. Then it can also leads to what we call double taxation. Double taxation. It can lead to what's called the double taxation. So if you look at the term under types of tax system, this question, either 2023 or 2024, as we will be revising, you will notice either 2023 or 2024, this question came. So these are the disadvantages of what we call a multiple tax system together. So then I want to talk about criteria for evaluating a tax system. Criteria, we talk about criteria. We must get everything. Criteria for what we call for evaluating. The word is evaluating what we call the tax systems. Criteria for basically evaluating what we call the tax systems. Criteria for evaluating, are we together? Tax system. So one of the ways that we evaluate tax system is basically based on the principle, so what we call the canon of taxation. It is based on principles, based on what you call on principles, so what you call the canons of taxation. So for those who attended my classes on the intermediate, the more, are we together? The more the system has, the more canons of taxation the system has, the more efficient the taxing system altogether. So the more canons the tax system has, the more efficient the tax system altogether. So how do we evaluate whether to go for a single tax system? Is based on the canons of taxation. And the very first four canons were developed by a scholar known who? The very first four canons, there's a scholar who was called Adam Smith. So the very first four canons were basically arrived by a scholar known as Adam Smith. So when the question is very specific and asks you, for example, canon of taxation based on Adam Smith, there were basically four. So we call it, one is certainty. So the one is what we call certainty. We have certainty. We have equity. We have convenience. We have convenience. And which one? Certainty, convenience, and what? And what? And economy. The canon of economy. So these are by Adam Smith. These are the first four. After Adam Smith, we came up with some. Are we together? Economy. Together. So those are the first four canons of taxation, and they will basically come up with a scholar known as Adam Smith. Together, team. So we can start with the first one down here. So when you talk about the canon of economy, it basically implies that the cost of tax should be cost effective. Cost effective. Look up, I'm explaining. It should be what's called cost effective. We don't need to write even much. Cost effective means the cost of collecting tax should not be more than the tax collected. So when you say the word cost effective, we're basically saying that the cost of collecting tax should not be more than the taxes collected. To Melawana Chebla, the cost of collecting tax should not be more than the taxes that are collected. The cost of collecting taxes should not be more than the taxes that are collected. That is what you mean by cost effective. That is basically what you mean by the cost effective. That the cost of collecting taxes should not be more than the taxes collected. Then you have the second, we call it convenience. Convenience altogether. A good tax system, are we together? Should be basically, we call it, should be convenient. It should not burden so much the taxpayer. It should be convenient to the taxpayer and tax collector. In terms of mode of payment, should be convenient to the taxpayer in terms of mode of what we call payment. Mode of payment. How do we collect mode and payment? It should be convenient to the taxpayer in terms of mode of payment and the mode of payment and the place of payment and the place of payment and the place of payment. It should be very clear. So it should not inconvenience the taxpayer in terms of mode of payment and the place of what we call payment. Together. Are we together? In terms of mode of payment and the place of payment. There's a certainty. Whenever we talk about certainty, we are talking about what we call surety. You need to be sure. When we talk about certainty, we need to be sure. Are we together? Certainty is sure. Are we together? On the part of when you talk about certainty, on the part of the taxpayer, on the tax of the taxpayer and the government itself, we should be certain about amount of tax payable to the government, and the government should also be certain, should also be sure in terms of the government should also be sure of amount they expect to collect from the taxpayer. Are we together? That is what we call certainty. Are we together? That is what we call certainty. The taxpayer should be certain about the tax payable to the government, and the government should also be certain about the amount expected to be collected in a given year. That is what we call certainty. Then when you talk about equity, we're basically saying that a good tax system should be fair. In that, we're saying, why do you think we have graduated scale? Why do you think we have graduated scale? A good tax system should be fair. In that, we're saying that those that earn more should be paying more taxes than those that earn less, than those that earn less. Together, those who earn more should be paying more taxes than those that earn less. But when you talk about equity, the two aspects of equity, there's what we call the vertical equity, and there's what we call horizontal. We call it horizontal equity. So we have two aspects of the equity. We have what's called the vertical equity, and then we have what's called the horizontal equity. So we're just saying, whenever we talk about vertical equity, the tax increases as income increases. Vertical is tax increases as income. We call it as income increases. Tax increases as the income is increasing. So on the horizontal tax, vertical, tax increases as the income increases. But when you talk about horizontal, that is just to say this, individuals in the same tax bracket altogether. Taxpayers earning the same amount should pay the same amount of tax. Taxpayers earning what we call the same amount should pay what we call the same tax. Should basically pay the same tax. So if taxpayers are earning the same amount, they should basically pay the same tax together and teach. That is on the two aspects of equity. The two aspects of equity. So that should be okay. Understood? If that is understood, we respond with a yes. If that is understood, we respond with a yes. And I've brought to the attention of the learners that particularly this question on the disadvantages of multiple tax, this is a question that basically came very recent. That was a very recent question. That was a very recent question. When you look at a question on multiple taxes, that's a question that basically came very recent altogether. That's a question that basically came recently. That's a question that we understand came recently. That's a question that we need to understand came recently. However, other canons, we speak about other canons very fast. Other canons. So when you talk about other canons, apart from the ones, these ones are very specific. These ones were basically come up with the Adam Smith. We also have other canons. So then we have simplicity, simplicity. We have simplicity. We have simplicity. We have productivity, productivity, productivity. We have what's called neutral, neutral, diversity. We have neutral, we have diversity, we have neutral, diversity, neutral, neutral, we have what's called diversity. We can explain this. Simple for a common person to understand. Can be understood by a common person. Can be understood. The word is can be understood by what? By a common person. When a tax system is simple by a common person, it can definitely be understood by a common person. So when a tax system is simple, it can basically be understood by a common person. Together, it can be understood by a common person. Then the word neutral, the word neutral does not interfere, should not interfere with the forces of demand and supply. Does not interfere. The word is interfere with what's called with the forces, with what's called the forces of what they call demand and supply in the market. So when a tax system is neutral, are we together? Does not interfere in the forces of demand and supply in the market, which assist in setting equilibrium price. Forces of demand and supply in the market, which assist in setting what you call the equilibrium price and quantity. Productivity, this one say will raise enough tax revenue. It should raise enough tax revenue. That is what's called productivity. Then diversity, several taxes composed of several taxes together. That is on the other canal. Tafadhali nipatie yes if you're there. Tafadhali nipatie yes. We also have issues to do with elastic and exactus. Elastic and etc. Are we together? So we have what we call uses of laughter curve in formulation of tax policy. Are we together? Uses of what we call laughter curve. Laughter curves in laughter curves in, call it laughter curve in formulation. Laughter curve in formulation. I just want to talk about in formulation of what we call the tax policies. Laughter curve in formulation of the tax policy. So we're basically saying it does stimulate what we call growth and investment and fiscal policies and budget together. So there are two things: stimulating growth and investment is touch of stimulating what we call growth and what we call the investment, and then fiscal policy. We touch on two aspects: fiscal policies and budgeting. We have what's called fiscal policies, and what's called the budget. Fiscal policy and the budget. Fiscal policy and the budget. So when you talk about fiscal policy, it touches on taxes and the expenditure. So we basically understand on fiscal policy and budget, this Laffer's curve is applied when formulating what's called economic policies and budget of a country altogether. It's formulating fiscal policies and the budget of a country, are we together? It tells policymakers to understand it. Basically understand what we call the implication. Policies makers, this is policies makers to do what? To understand implications, what we call the implications, to understand what we call the implications, to basically understand the implications of policies in economy, of policies in what we call in the economy. Together, policies in economy. Then we talk about stimulating growth and investment. Stimulating growth and investment. So we say the Laffer's curve is used to stimulate what we call growth, since lower tax rate on company can encourage investment. Lower tax rate on companies, lower tax rate on what we call on the company can, the word is can encourage what we call investments. Can encourage what we call invest. So saying lower tax rate on companies, we understand that can easily encourage what we call investment. Can easily encourage what we call investment. Together, team, that is on Laffer curve. Role of taxation in economic development. So we talk briefly on role of what we call taxation. Taxation on what we call on economic development. Role of what we call taxation on economic development altogether. So what is the purpose? Role, we talk about the purpose of what we call functions of tax in an economy. Purpose, this is purpose. So what we call the functions of what we call tax in what we call in the economy. Roles to what we call functions of tax in the economy. So when you talk about roles to what we call functions of tax, the first is raise revenue for the government. We talk about raise revenue, raise what we call revenue for what we call for the government. It does what? Raise revenue for the government. One of the first role is to raise revenue for the government. Are we together? Fair distribution of resources. What do you have as fair? Fair distribution of what we call of the resources. We have what we call fair distribution of the resources. Apart from that, fair distribution, protection of local industry. Protection, we can use them where? Protection of what we call local industry. Where we charge high, we raise the input duty to encourage people to do what? To consume altogether. So job employment as a role, creation, so what we call job creation of what we call of employment. If you look at kazi kwa vijana and etc., those are all of taxes. And you can, not the last one, we can have attracting investment. You can lower the taxes, attracting. We can talk about attracting what you have as investment. Attracting what's called the investments. Those are, how do we attract investment? We attract investment by lowering the tax rate, but at the same time, we use the revenue collected to build infrastructure, which we understand will attract investors to a country. Tuko sawa on that, which will attract investor to a country. Kama tuko pamoja tubonyeze yes. Kama tuko pamoja tubonyeze yes. We respond to the yes. So thank you so much. Challenges facing developing country while formulating the tax systems and policies. So what are challenges facing developing countries? Challenges. We call it facing what we call developing countries. Developing countries. While, the word is while formulating what we call tax policies. While formulating what we call the tax policies. While they're formulating what we call tax policies and tax systems. And what we call the tax systems. This is has also been a question that has been coming. So the challenges that we say face, what we call developing countries, when they're formulating the tax policies, while they're formulating the tax policies, what are these challenges? Developing country, Kenya being one of them. So we must understand that developing country, Kenya being one of them, they do not have what's called effective and efficient taxing system. Are we together? Effective and efficient tax system. Are we in agreement? So we must agree that developing countries, Kenya being one, they do not have efficient and effective tax system. So we must agree. Yes. So some of the issues they experience, lack of experienced human resource. Corruption is also one of them. We also have corruption. Corruption is one of them. When you ask corruption, money is not, resources, corruption is one of the things which can prevent realization of that objective. But, lack of political will, lack of what we call political will, or we call it lack of what we call political will, where politicians are together. I've even known as a team that politics plays a big factor. If any of you was a politician, was an MP, or was in power, you play a huge part towards your people doing better or they don't do better. Do you know that? Yes. So we lack of political will, but you also have issues to do with political instability, political instability, what we call political instability. We have what we call political instability. Low investment again altogether. Low investment altogether. Existence of few resources. Low investment. We call it low investment, and that is what we call existence of few resources altogether. But we also have what we call uneven distribution of income. Uneven distribution, we call it uneven distribution. The word is distribution of what we call income. So we have what we call uneven distribution of income. That is to say that most of the country's large amount of it are usually in the hands of few people. Few people, which reduce what we call the number of people who can contribute to what we call taxes altogether. No wonder, for example, when we talk about GDP and per capita income, we don't feel it altogether, because if you look at this income is in the hands of few people. Have you ever noted? When you talk about per capita income and GDP, we don't experience it, because most of this money is on a single, there's just few people who basically have those money, and those who contribute to the GDP and per capita income. Perfect. So then we say limitations of tax policies in attaining what's called economic objectives of a country. Limitation of tax policy. We have what's called limitations. Limitations of what we call of tax policies. Policies. We say in attaining. The word is in attaining. In attaining what we call objectives of a country. Objectives of what we call of a country. Limitations of tax policy in obtaining what we call objectives of a country. One of the limitations is tax evasion and avoidance. What we call tax evasion, we call it tax evasion, and what's called avoidance. Tax evasion and avoidance. Tax evasion, so the government collecting less tax. That basically implies that the government basically collecting what we call less tax altogether. Then we have what's called revenue. The second, we have what's called revenue, and we call it volatility. Revenue volatility. We have what we call the revenue volatility. We have what's called revenue volatility altogether. So, volatility, it means that the revenue is basically collected by a number of various factors altogether, like economic downturn altogether, revenue decline, which can constrain what we call budget. So revenue volatility, that is caused by economic turndowns altogether. So budgets cannot basically be fulfilled altogether. Then social considerations altogether. Social consideration. We have what we call social considerations. So whenever we talk about the social considerations, we know that sometimes taxes face resistance from public altogether and interest group altogether. Is that true? Face resistance from the public. Social factors, taxes face taxes face what we call resistance, and the word is from what we call from the public. Sometimes they face what we call resistance from the public. Sometimes these taxes, we understand, face resistance from the public altogether. We respond with yes. We respond with yes. Are we together? So I want to touch briefly on tax reforms in Kenya. Tax reforms in Kenya. Tax reforms in what we call in Kenya. Tax reforms What are some of the reforms that we've seen in Kenya? What are some of the major reforms? What are some of the tax reforms? So these are rules that regulate what we call regulate to make tax system effective. So what are major reforms that have been basically carried out by Kenya Revenue Authority? So the major reform is formation of a large taxpayers and medium taxpayers unit. That is one of the biggest reforms. Large and medium taxpayers unit. Are we together? Formation of this large and medium taxpayers unit as one of the reforms that have basically been done together. So these reforms are basically touches on the formation of large and what we call medium taxpayers unit. What have they carried out? Large and medium. So what have they done? The units are basically done what? So they have offered as a reform taxpayer services. What do you call the taxpayers services? They have basically offered what you call the taxpayer services. Are we together? Taxpayer are we together? Recruiting the taxpayers, and we have tax education. Recruitment and tax education. We have recruitment, and what we call tax education. Major reforms lies on the formation of the large taxpayers unit and the medium taxpayer service altogether. That is education and what we call recruitment. But again, audit and research department. We have what we call audit and what we call research department. Audit and what we call the research department. Audit and what we call the research department. What does it do? On creation of that, what does the audit and research department? What does it do? It focuses on issues of refund, but again, issues of refund claims, objections, and appeal. Are we together? And appeal. Are we together? Then we have compliance and debt management department. Compliance, and what's called the debt management department. For those who practice, have we come across these reforms, particularly on the large and medium taxpayers unit? So we have compliances and debt management unit altogether, and debt management unit. Are we together? Have we experienced, for those who practice, collection of tax in arrears and what we call compliance of the taxpayers to rules and regulations. So formation of the large and taxpayers unit, basically these services, we have the taxpayer service recruitment and education, we have audit and research, audit and research department, we have what we call compliance and debt management, we call it department. Together, team. If you're together, we respond with a yes. So what are the reasons for basically formation? Reason for formation, we call it for formation of what we call large and medium, and what's called medium taxpayers unit. Medium taxpayer unit. So what is the reasons for what we call formation of large and medium taxpayers unit? So the reason for formation of that was to, they come in line of this department, some of these services. Say specialized attention to, so specialized attention to the taxpayer, specialized attention, we call it attention to what? To the taxpayer. Specialized attention to what we call to the taxpayer. Specialized attention to give a specialized attention to the taxpayer, to reduce what's called tax evasion, to basically come in and reduce what's called tax evasion, to reduce what's called tax evasion, to increase tax collection, we understand to increase what we call the tax collection, to increase what's called the tax collection, to basically come in and increase tax collection. Professionalism in handling tax matters. Professionalism in what? In handling what's called the tax matters. To bring in professionalism in basically handling what we call the tax matters. We respond with a yes. Kama tuko pamoja. Perfect. Thank you. Are we together, Tebla? Are we together, Ngetich? Are we together, Victor? Are we together, Sally? Perfect. So then I want us to go to challenges encountered. Challenges that are encountered by government in the use of tax policies. Challenges encountered. Challenges encountered by what they call the government. Encountered by the government in use of tax policies, in use of what we call of tax policies, in use of what we call the tax policies to address distortion, to address what we call distortion, to address what we have as distortion, to address what we call distortion. So the challenges that are encountered by the government, we call it challenges that are basically encountered by the government in addressing what we call economic distortions. So I want us to understand what we call economic distortion. Economic distortions. So what does the word economic distortion basically stands for? When you say economic distortion, what are the word economic distortion basically stands for? Are we together? So this is basically inefficiency in allocations. We call it inefficiencies. Efficiencies in what's called in allocation. We call it in allocations of what we call of the resources. Inefficiencies in the allocation of resources. But the good things with the notes, I also want to encourage the good thing that with the notes that I'm giving you, if you sit down, I'll also give you, I'll be able to provide theory questions and answer. If you go through if we discuss this and you go even to the paper, even before we revise, you'll just find the exact things. So distortion, I'm saying, is inefficiency in allocation of resources, which that occurs when market prices do not reflect conditions. When market price, which we understand reflects when the market prices, we understand when the market prices do not actually reflect. Market prices do not, when market prices, when market resources, when market price, inefficient allocation of resources, when market prices do not actually reflect, we call it, the word is reflect, conditions of what we call demand and supply do not reflect what we call conditions of demand and supply. So that is what we call economic distortion. Inefficiency in allocation of resources when the market prices do not actually reflect what we call demand and supply in the market. So how does challenges that government encounter when they use tax policies to address economic distortion? Have we understood what distortion is? We respond with a yes. We respond with a yes. So the challenges that basically government encounter in use of tax policy to address the distortion. One is what we call economic complexity. We call them economic complexity. We call them the economic complexity. On economic complexities, we understand predicting effect of tax changes in the economy is difficult. Predicting effect of tax changes is difficult. So predicting what we call the effects of tax changes, we understand is difficult due to what we call complex interactions. Due to what we call complex interactions. Due to what we call complex interaction. So that is what we call economic complexity. Then you have revenue constraint. Those distortion lack of revenue constraint. We have what we call revenue constraint. Revenue reducing distortion may lower revenue. Are we together? May lower revenue, may lower what we call revenue. This may definitely lower what we call the revenue, may lower the revenue, affecting public funding. And say affecting, the word is affecting what we call public funding. So when you try to lower those constraints together, it may lower what we call revenue. As the next, then we have what we call, we can talk about political and public resistance. So together, political and what we call the public resistance. Political and what we call the public resistance altogether. So reforms often face resistance. Have you ever seen some at times when reforms face what we call public resistance? The reforms that are happening in the public basically resist. Have you ever seen? Yes, they may face resistance from the public and political. Are we together? Then administrative complexity. We have what we call administrative complexity. Administrative complexity, call the next, we'll call it administrative. We can talk about administrative complexities, administrative complexity. So when you touch on administrative complexity, implementing tax policy can be challenging administratively. Are we together? Can be challenging. Are we together? Tax policy can be administratively challenging and costly. In terms of even cost, cost, it can be very expensive. Are we together? It can be very costly. The word is costly. Are we together? So unforeseen consequences. We can talk about unintended. We can have what's called unintended, intended. We call it consequences. Unintended consequences. It can lead to what we call unintended consequences. Are we together? So it can lead to increased evasion and avoidance. Tuko pamoja on that. So tax policies and systems tumemaliza. Are we together? Are we together on tax systems, touching on policies? That is done. Give me a yes. Perfect. Let's just go through all of them, then we'll just revise. So we go to professional ethics in taxation. The next is professional. We talk about professional ethics in what's called in taxation. Professional ethics in taxation. Professional ethics in taxation. The first thing is to define what you mean by ethics. Professional ethics in taxation. Professional ethics in taxation. Are we together? So when we say ethics, so this is basically code of conduct that regulate tax practitioners in practice. Code of conduct. This is what we call code of what we call conducts. Conducts that we say that regulates. That we say regulates the tax practitioners. That regulates what we call the tax practitioners in what we call in practice. That regulate what we call the tax practitioners in practice. So that is what we call the code of conduct that basically regulate tax practitioners while in practice. Are we together? So that is what we call ethics. Are we together? Are we together? Regulate what we call the tax practitioners in practice. Are we together? Tax practitioners in practice. Who comes up with this code of conduct? The body that comes up with this code of conduct. One of the bodies that come up with this code of conduct. So we call it code of conduct for ethics. For accountants. We have the EACC, but you also have, fundamentally we have the ISPA, which is the accounting body. We have ISPA coming together. We have ISPA coming together as one of the body. ISPA, especially on accounting. Who come up with the code of conduct? That is the ISPA. Together, Victor tuko pamoja. We respond with a yes. So then, this question has also come many times, code of ethics in taxation. So the code of ethics, we have one of it is integrity. Just name it down. We have integrity. And when you get to questions, you really see that you have everything with you. Integrity, we have objectivity. We have integrity, objectivity. So we have professional competence and due care, what we call professional, and we call it competence, and what's called and due care. So professional competence and due care, what we call the professional competence and due care. Professional competence and due care. We have issues to do with independence. We have issues to do with independence. We have issues to do with independence. We start with those. So when you talk about integrity as one of the code of ethics, are we together? So straightforward, and we say honest and straightforward. When you say integrity, they should be straightforward and honest while dealing with client. Straightforward. The word is straightforward, and what's called honest when dealing. When dealing with who? With the client. When dealing with the client. Straightforward and honest. They would say when dealing with a client. It should basically be straightforward and honest when dealing with the client. Straightforward and honest when dealing with the client. That is what we call integrity. Together, tabla. That is what we call integrity. Together. We respond with a yes. That is integrity. What is objectivity? When you say objectivity, as one of the called objectivity. So we just say a member of it together as an accountant, they should not compromise of it together. What we call professional judgment because of conflict of interest altogether due to influence of others. Judgment, compromise, The one is judgment. Judgment. And you say due to what we call conflict of what we call interest or influence from others, or what we call influence from others. That is just biasness. They should not be biased. Objectivity, you're not biased. Together, objectivity, you're not biased. Then whenever we talk about competence and due care, so when you talk about professional competence and what we call due care, professional competence and what we call the due care, a member, as a professional tax consultant, you need to be what? Possess what we call professional knowledge and skill. Professional knowledge and skill. Professional, we call it professional. And the word is knowledge and skill. Knowledge and what we call skills. You should possess professional knowledge and skills. Professional knowledge and skill in offering bettering services. In offering what we call better. The word is better services, better services. Like what you do, you're basically acquiring what you call professional knowledge and skill, and this will assist you to do what? Offer better service to clients altogether. So how do you, as a professional, you must keep on updating yourself with the current standards, rules, and regulations. In order for you to offer better services to the clients, you need to keep on updating yourself on what you call on regulations and standards altogether. Are we together? Then we say independence, free from influence from third party. This is just to say free from what we call from influence. The word is influence. Free from what we call influence from what we call from the third party. From the third party. So they should be free from influence. And saying that the influence that basically comes from third party, they should basically be free from such influence. Are we together? So then we have two aspects. For those who did audit, we understand we have two aspects of independence. We have what we call independence of appearance. We have what we call independence of appearance. Independence of what we call of appearance. Independence of appearance. We have what we call independence of appearance. Independence, we have it as independence of appearance. Independence of appearance. And independence of mind or fact. So we have independence of what we call mind. So the two types, free from influence or from third party. But we have two aspects of independence. So when you talk about independence of appearance, we know that when third party with all knowledge, when you talk about third party with all knowledge concerning tax practitioner, will conclude that they are independent. That is what we call independence of appearance altogether. Consider it independence of appearance altogether. Together. When a taxpayer with all knowledge concerning tax will conclude independent, working for relatively third party, that is what we call independence of appearance altogether. So then we have what we call independence of actions to what we call fact altogether. So this is based on actions of the tax practitioner while they practice. So this is based on action of mind, so what we call facts. This is basically based on the action of the tax practitioner, action of tax practitioner when they carry out their work, together, when they carry out their work. Actions of the tax practitioner when they carry out their work. So this is based on a knowledgeable client altogether, or knowledgeable third party acknowledgement on the tax practitioner. But this is based on their action, independence of mind or facts, based on action as they carry out duty altogether. They ensure that they are free from influence. Is that understood? Tafadhali tubonyeze yes kama tuko pamoja. What's that? Are we together? If you're together, give me yes, so that we proceed. So then we have what's called confidentiality. Confidentiality. So we have what's called confidentiality. Do not disclose client information to third party. Do not disclose what you call client info to what? To third party. However, the scenarios that as a practitioner, you're allowed. So you're saying that do not disclose client information to the third party, that is confidentiality altogether. So, however, there are circumstances where it's allowed. So we call them circumstances where it's allowed. Circumstances where you allow, circumstances where it is allowed. We talk about circumstances where it is allowed. We call it circumstances where we understand it is allowed. Circumstances where we understand it's allowed. Then the tax practitioner can basically disclose the client information altogether. So one of it is legal obligation or court order. Legal obligation to what we call a court order. Court order will allow you to disclose. Those are circumstances where you're allowed to disclose altogether. So we should have started with this permission from the client. When there's permission, express permission from the client, we talk about permission from the client. Permission, government officers such as government. So where government officers such as information on EG. We have issues to do with help. KRA official etc. KRA officials etc. KRA official etc. Government officers AGL, KRA officers etc. Then you also have issues to do with public interest. When it's public interest for you to disclose, we call it public interest. We call it the public interest. So those circumstances, those four circumstances we have talked about, you're allowed to disclose them together. Are we together? Then the last code of ethics is what's called professional. We call it professional behavior. For those good students who go and revise before Mwalimu, have you ever seen questions on ethics in taxation? Are we together? Have you seen this? Yes. For those who revise before Mwalimu, we just want to try this semester. That was our goal, to try as much as possible, not to leave doors for anything. We just do the all work and leave nothing for us to panic. So when you talk about professional behavior, a person who acts professionally, we understand comply with relevant rules and regulation. Are we together? So we say comply. One of the things is this: comply with what's called with relevant rules and what we call regulations. Relevant rules and what we call regulation. If you're a professional, relevant, and avoid action that might discredit profession, and avoid actions, what's called actions that may discredit profession. So that we look at tax consultants and we begin to wonder, really, is this how things go? So comply with what's called relevant rules and regulation and avoid actions that basically may discredit professions altogether. So what are these actions that may basically discredit profession? A tax profession. What are these actions? So you make exaggerated claims about services. Exaggerated claims of what we call services. Exaggerated claims of services. They offer. We have experience, and what's called qualifications. Experience and qualifications. You make exaggerated claims on that. Then you say making unsubstantiated comparison to others' work, and making what's called unsubstantiated comparison. The word is comparison to what you call to others' work. So you're making unsubstantiated comparison, and you say to others' work. You are making what you call unsubstantiated comparison to others' work. You make unsubstantiated comparison to others' work. Those are code of ethics. Is that understood? On the code of ethics, all of us, do we say that we have understood? All of us, can we stand and say that we have understood that? Nimeshukuru. So then I want to proceed to what we call conflict of interest. Conflict of what we call of interest. Conflict of interest. Conflict of interest. Conflict of interest. Conflict of interest. What is conflict of interest? So it is basically a situation or factor that causes a tax practitioner to lack ethics in the work. It is a situation, we call it situation or factor, or situation that causes a tax practitioner, what do you call a tax practitioner, to lack ethics in their work, to lack what's called ethics in what's called in their work, in what's called their work. So it's basically a factor of a situation that we say causes a tax practitioner to basically lack ethics in their work. To lack what? Ethics in their work. To basically lack what's called ethics in their work altogether. So lack of ethics in their work, for example, confidentiality, objectivity, etc. Are we together? What are some of these factors that will cause a tax practitioner to lack ethics? The ethics that we've talked about, integrity, objectivity, independence, confidentiality. What are these situations? You're a tax practitioner. One is being a shareholder in a car. One is being what they call being a shareholder in what's called in a company. Do you think you'll act in the right way in a client company? Being a shareholder in a client company. What happens? You're a tax practitioner, but you're also a shareholder in the company. Do you think you'll uphold ethics? No, you will not. Are we together? Number one, integrity will be questioned when it comes to, because you're after money. You not want, in terms of taxes, you not give the right position. Then you say family relationship with the client. When you want family, we have what we call family relationship with what we call with the client. One of the best things that professionals do, for example, when you have your brother and he wants you to solve tax issues, sometimes it's good to give it to another person. Is it the right thing to do? Victor and Sally and Ngetich and Chepchumba and Tebla and Robert. So when you have a family member who has a tax issues, are you able to remain professional? In most cases, you may not. So it's just good to give it to another consultant. So they say working for rival firms. We have working for rival. What do you call for rival? Working for the rival firm. So financial relationship with clients altogether. Getting loans from the clients. Financial relationship, and call it with. So financial relationship with the client that you are getting loans from the client altogether. that is dangerous. Okay, you not be very objective. There is other business relationship with the client. So we can call other business relationship, we call it with the client. Other business relationship with the client. Other business relationship, we say, with the client. Being a supplier of the client. For example, you're a supplier of the client. There's a lot of compromise which can being a supplier of the client. That puts you in a very dangerous spot. That will definitely put you in a dangerous path. That will definitely put you in a dangerous path. So again, also deriving revenue from one client. Deriving. So we can have one deriving what we call revenue from what we call from the client, from one client. So those are conflict of interest. So I want us to talk about safeguards to conflict of interest. What we call safeguards. Safeguards to do what? To conflict of what we call of interest. Safeguard to the conflicts of interest. How do I safeguard conflict of interest? So do you think this question is technical? It's not technical. It's a very easy question. I understand reasons why. If I understand reasons why, the opposite becomes so notify client of the business interest. One is notify the client of business interest. Notify the clients of the business interest, shareholding or other business relationship. So one of the ways to handle it, notify the client of the business interest, shareholding or other business interest altogether. So if you're working for rival, in case of working for rivals, the word is working for what you call for rivals. In case of working, notify relevant parties. Notify what you call the relevant parties. Then if you're working for rival, then you need to notify the rival. But again, with those rival, again, you need to have separate engagement team, separate engagement team in case of working for rival. If you have different teams, have separate teams. Separate engagement team in case of working for rival. We have separate, we call it engagement teams. Engagement teams when working. We have it when working, and we call it for rivals. In case you're working for rivals, then you need to have what's called separate engagement team. You need to have what's called separate engagement team, especially when you're working for the rival. You need to have what's called separate engagement team, especially when working for rivals. Together team. You need to have what's called separate separate engagement teams, especially when you're working for the rivals. So then we talk about put measures to prevent access to information. Measures, put measures to prevent, prevent what's called access to what we call to the information. Put measures to prevent access to what we call to the information. Put measures to prevent access to information. That is what we call physical separation and secure data finding altogether. Then you can say use confidentiality agreement signed by employee. Confidentiality, use what's called confidentiality agreements, we call them agreements, confidentiality agreements, signed by employees and partners of firm, signed by what we call employees and what we call partners of the firm, of what we call all the firms. Those 5 are enough right here. So you need to notify clients when you're working for rival and executors together. Are we together? Is that sorted on that? I hope we are together on that. I hope that is understood. So the risk of conflict as an NP. Read out on those points again. Number 1, we say you notify the client of business interest, for example, shareholding or other interest. In case of working for rival, notify what you call relevant parties. Then when you're working for rivals, you have a team of 10 people. Make sure 5 are working for one and 5 are working for that separate engagement team. Then put measures to prevent access to what you call information, those are confidentiality. Put measures to prevent access to information. Then use what you call confidentiality agreements signed by employees and parties of the firm together. Tafadhali tubonyeze yes. Ngetich. Kama tuko pamoja, you give mwalimu a yes. So then I hope you don't need a small break. We just finish. So we just continue to the end. There's no need of taking a break. I want by tomorrow we should be on ADR, or we should start on ADR today. So then procedures followed when accepting professional appointment or a new tax client. I know people don't follow this. I know in Kenya, do we follow procedures in accepting a new client? Or when we get a new client, it's hot cake because we're looking for money. Do we follow these procedures? I know procedures, these are not definitely not for follows. So we call it procedures followed. Procedures followed. We call it procedures. Procedures. We call it followed. 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 When accepting professional appointment, when we say accepting what's called professional appointment. When accepting what's called professional appointment. So the procedures that are followed when you talk about accepting what's called professional appointment or accepting a new client, or what you call it accepting a new client. Accepting what's called a new client. So if any of you gets a new client, do you think there's a procedure that needs to be followed? If you get a new client today, you get a new client. Do you always think of a procedure, or you just take the client and continue with the journey? Do you think there's a procedure that ought to be followed when you get a new client? No one follows it altogether. So, but there should be a procedure, steps that are followed before accepting appointment altogether. So the clients, the clients that will put you to high risk, are we together? The clients that will put you to high risk. So we say one of the first things that you need to understand is the history of the client. So one of the first procedures is basically tabla. We call it the history of what we call of the client. One key thing is what we call the history of the client. And I hope you'll follow these procedures. I hope we'll not just take client. We'll understand the history of a client. One is the history of a client. Are we together? We call it the history of client. Are we together? Whether they are professional or other reason not to accept the client altogether. Reviewing the history profile of the client. Is he a non-tax evader? Is this client that you're taking a non-tax evader or engaged in legal business altogether? Or engaging in illegal business? Very key. So the next procedure is basically communicating with existing practice. Communicating, we call it communicating. Communicating with what you call with the existing. I know people don't existing practitioner. Practitioner. People take the job without even talking to. It's good to ask how it can. When you see one is leaving, there could be very key issues communicating with what you call existing practitioner. How it can. After getting permission from the client. Number one, you need to get the permission from the client, traveler in the team, to talk to existing practitioner. How it can. So for the reason, and find out if there's any reason not to accept the client. Let's say, for example, yes, it won't allow, but that raises Allah. Are we together? We're in a country, but that raises Allah. It won't be allowed. That raises Allah. Are we together? That raises Allah. That should even tell you, don't take that. Are we together? That should even tell you, but I know we're in a country where there's a lot of lack of money. But again, the very fundamental. They say third-party confirmation. You can also have what you call third party. We have what you call third party. Third party, we call it confirmation. We call it third party confirmation. When you talk about the third party confirmation, we say that suppliers, employees are together. If there's any other reason not to accept together. Then you have lastly what's called contractual. What you call the contractual agreement. We call it the contractual agreement. Last, we call it the contractual agreement. We call it the contractual agreement. Make sure the appointment is through a written agreement altogether, stating what we call responsibility of the practitioner. And I think in most cases, people don't even write. Who writes those agreements? Who tries and have an agreement? As a professional, try implementing those. It will save you a lot. Make sure that you have accept appointment with a written agreement altogether, stating clearly the responsibility of what you call of the practitioner together. Then you have tax a practitioner's obligation to a client. Tax practitioner obligation. We call it obligation to who? To a client. Tax practitioner's obligation to a client. What is your obligation as a tax practitioner? Some people don't know their obligation. So you act as an agent of the client, agent of the client on all tax matters, agent of all tax matters of the client, agent of what called of all tax matters of what you call of the client. So that is one of your role. You are agent of all tax matters altogether. Agent of tax compliance, agent of what you call the tax compliance, agent of what you call the tax compliance, agents of what you call tax compliance, agent of all corporate tax matters, agent of what you call agent of all tax corporate matters, agent of all tax corporate matters, agent of what you call of all tax corporate matters. Tuko sawa? Are we together? Are we together? Of all corporate tax matters. Then I want to talk about something very interesting. Charging for fees. How do you charge for fee? Charging for fee. Charging, and you call it for fee. Charging for fee. How do you charge for fee as a tax practitioner? What is the basis that we should use to charge for fee? What is the basis that we should use to charge for fee? What is the basis that we should use to charge for fee? Sorry. as a tax practitioner, what should be the basis? So we must appreciate, yes, we must appreciate that there's not a specific set of criteria on how we should charge client fee. However, it should be based on a number of things. There's not a set criteria, we say, for charging client altogether. However, it should we base charging client on, it is based on a number of things. There's not a set criteria that we charge for fee. However, yes, that is a good time required to do the work. So you look at the time required. So some of the things that time required to do what they call to do the work. Time required to do the work. One is one of the criteria. They say number of professionals required to do the work. Number of professionals. Number of what they call professionals. Professionals required to do the work. Required to do what? To do the work. Number of the professionals that are required to do the work. Number of what they call professionals required to do the work. Skills and experience of professional required to do the work. Skills, so you can have skills and what's called experience of what they call of the professional. We say required to do the work. Skills and experience of the professional that is required to do the work together. We still have time. But we still have time. I know by 7 we finish, but Mwalimu still has time. Is it true, Sally? My time is still there. So then, we'll talk about ethical and moral challenges. Tax practitioners, ethical and moral challenges. Ethical. We have ethical and what's called moral challenges. Ethical and moral challenges. We have what's called ethical and moral challenges. Tax practitioners, we call it tax practitioners faces. So we have what we call ethical and moral challenges, and you say that the tax practitioners faces when balancing duty to client and their responsibility. When balancing what we call duty to client, and duty to client and what we call responsibility to tax system. And responsibility to what? To tax system. And the responsibility to the tax system. And what we call the responsibility to the tax system. And the responsibility to the tax system. So ethical and moral challenges a tax practitioner face. What do you face as tax practitioners? This is a question that comes a lot of times. So what are these challenges? So ethical and moral challenges. If you look at even the last 2024, 2023, this question was repeated. I know December, that question was there. This question, ethical and moral challenges tax practitioners face, balancing duty to client and what's called and responsibility to the tax system. Reporting errors. One is reporting errors. Reporting errors. I want us to, how do you go about it when it comes to reporting errors? If you discover a material error or omission in client's prior tax system, What should you do as a tax practitioner? What should you do? When you discover error in a previous, what you call previous material error or omission in plans prior tax return. As a tax practitioner, you're obligated to do what? To report to the client and advise accordingly. Are we together? And advise accordingly. Are we in agreement? So as a tax practitioner, if you discover material error or omission, if you discover what you call material error or omission, you're obligated, to report to the client and advise accordingly. However, some of the things that you face as you practice, there's what you call client resistance altogether. Are we together? So especially when it results into additional, there's what you call resistance, especially we talk about resistance, especially, we call it especially when it results, the word is results to what we call additional taxes. Clients always, at all times, they will always want you to reduce the tax, especially when it results to additional taxes, interest, or penalties altogether. So how do you balance that altogether? How do you balance that? So they must balance their duty to what they call to client and responsibility to the tax system. So one of the things that there was always resistance when it results to additional tax, interest, and what's called penalties. But at the same time, as a client, as a tax practitioner, you have to balance the duty to what we call duty to the client and responsibility to what? To the tax system. Do we face this for those who practice? Yes, that is something that is faced together. So another one is managing client expectation. And this one I know is something managing client expectation. Managing what we call client expectation. This is a huge one. How do you manage client expectation? For example, Sally, if in situations where a client, what is always the client expectation? So the expectation is always to deliver the lowest tax possible. The expectation delivering what we call the lowest tax bill possible. Is that true for those who practice? In most cases, the client will always want you to deliver the lowest tax bill as possible. Are we together? It will tell you, look for any ways to reduce, to deliver what we call the lowest tax possible. Together. And sometimes this is pressure together. Are we together? And especially sometimes they have questions about tax return together. The lowest tax possible. That is always what a client will always, if it's zero can be, a client will always want you to deliver zero. But sometimes pressure them to make what we call unquestionable position on tax return. This happened, unquestionable tax position on unquestionable. So this is where we have unquestionable tax positions on what we call on the returns. This is where we'll have unquestionable tax positions on the returns. We'll have unquestionable tax positions on the return. Then you have what we call issues to do with professional judgment on standards. Remember, as a tax practitioner, you have to run on standards. Are we together? So what should you do? Resist pressure and avoid compromising integrity. So you're supposed to resist pressure. Resist what's called pressure. You're supposed to resist pressure and avoid issues that will question. Issues that put your integrity in question. Your integrity in what's called in questions. Avoid issues that will put your integrity in question. Are we together? What do? You need money. In Kenya, you will thrive. Aggressive tax planning. We call it aggressive tax planning. The next we call it aggressive. We call it aggressive tax planning. We have it as aggressive tax planning. The next we call it aggressive tax planning. So one of the primary ethical dilemma is where when a client seeks aggressive tax strategy, when a client requires what's called aggressive tax strategy that push boundaries, they can sometimes be these policies, sometimes aggressive tax policies, they may sometimes be viewed as unethical. So aggressive tax policy, you're pushed by the class on these aggressive tax policies. Sometimes they may be viewed as unethical or contrary to the spirit of tax code. So as a professional tax practitioner, you must basically make a decision whether to support such strategies or advise them against it. So that's aggressive tax policy. A client may sometimes push you, but contrary to that, sometimes you feel those policies, aggressive tax policies, may be contrary. So as a client, you're supposed to do what? To advise the client accordingly. Together, advise the client accordingly. Then you have what's called professional judgment. We have what's called professional judgment. Do you think clients love professional judgment? Do you think they love professional judgment? Do you think they love professional judgment? Especially when you want to tell the client to follow the law. Do you think they love? But you are required to use what's called professional judgment to navigate ethical. Professional judgment, we say professional judgments to do what? To navigate. Navigate. We call it navigate, what's called ethical dilemma. Ethical dilemmas. To navigate what we call ethical dilemma. Are we together? So it must be consistent with the law and ethical standard. That is what's called professional judgment. At all times, a client may push you, but then it's very important to have what's called professional judgment. So those are some of the issues, ethical or moral issues that you need to consider. But lastly, we have what's called confidential. We have what's called the confidentiality. We have what's called the confidentiality. We talked about confidentiality altogether. Not disclosing, but however, we talked about also scenarios where we can disclose altogether. We can disclose information altogether. So this in confidentiality, we understand that builds trust and ensure that the client feel free to discuss everything together. However, you can face with dilemmas altogether. A taxpayer may be faced with dilemma together. Where information is needed by the tax authority, but the client direction is to withhold information. So where tax authority requires what we call information, but the client does not agree to it, does not agree to it. Does not agree or with all the information. What do you do? A tax authority requires information, but the client decides that they are not going to do what? They are not going to basically give out that information together. So these are the challenges or dilemmas that a tax practitioner basically face when the balancing what to client, duty to client, and responsibility to tax system. together. Bonyeza yes kama tuko pamoja. I just want to introduce ADRs. I just introduce only alternative dispute resolution. Very good area. And it came in the last sitting. I know some of the things on ADR or resolutions, ADR. Alternative, we call it alternative dispute resolution, ADR. Alternative, and call it dispute resolution. Alternative dispute resolution. Alternative dispute resolutions. Alternative dispute resolution. That is what we call ADR. ADR. We just introduce alternative dispute resolution and we call it the ADR. Alternative dispute resolution. What are ADRs? What are ADR? ADR. ADR. So we have so many ways of solving the dispute altogether. Are we together? So we where does dispute start? Where does dispute start? Where does the dispute start? Tim, where does dispute start? It starts with the commission, taxpayer and the commissioner. See, that's where the dispute starts. Sometimes it goes to what we call the tax tribunal, it goes to the court, or sometimes we'll just find disputes, they come from what we call the commissioner without going to the tribunal. They go to the ADR altogether. Or sometimes after rotating ADR court, after rotating from the tribunal, you go to the court, then you just go back to the ADR altogether. That is, you just go to the ADR. But you can come from the commissioners. Most of the disputes stems from the commissioner. Are we in agreement? Arise between the taxpayer and the commissioner. Are we in agreement? Yes, most of them will always emanate that. But what people don't understand, that the disputes that don't even go to the tax tribunal, they go to the ADR immediately. Is that true? That disputes that don't even go to the tax tribunal, they just come from the commissioner to the ADR. Are we in agreement? So we start how disputes arise. We start with how disputes arise. Because for even going to the ADR, there must be dispute. So we call it how disputes arise. We call it how tax disputes arise. How the tax disputes, before you go to ADR, how the tax disputes arises. So what takes you to the ADR? It's the disputes. It is not any other thing, but it's the dispute altogether. It is the dispute. So we start with what we call a tax assessment altogether. A tax assessment. We have what's called tax assessments. Are we together? Tax assessment. So tax assessment. There will be a tax assessment altogether. Assessment is done, and then you're told this and this tax you need to pay. So when you get an assessment as a taxpayer, you're expected to respond or object within. You're expected to respond. Or object. The word is or object within. What is the statutory period of objecting or responding to what you call an assessment? Most of it will start from the assessment. Within 60 days, based on which changes? Based on what changes? Based on what? Based on what? The 2025 altogether. But initially it was 30. Are we together? Most of the things that you're going to do, because you're going to touch on 24, will still touch on 30 days. You'll still touch on 30 days altogether. Or do what I'm saying, most of the disputes that you're still going to touch on, because that's previously, they'll still touch on the 30 days altogether. They'll still touch on the 30 days altogether. So when you will respond with that on Twitter, if you touch on that, they will still touch on 30 days. Are we together? Responding within 30 days. However, with the changes 60, we have the 60 together. So you can either agree. When assessment is done, you can either agree with assessment or deny the assessment altogether. So denying the assessment is what we call a tax objection. Are we together? Is what we call a tax objection. You're refusing. You have been slapped with an assessment that you need to pay 30 million. So when you deny, we call it an objection. Are we together? Are we together? So upon receipt of an objection, commissioners, upon receipt, I just talk about it, upon receipt of what we call an objection. Taxpayer is saying no, and he furnishes documents, and he brings the proofs. So upon receipt of an objection, a commissioner has a number of options, we call it options, available. We call it available to who? To the commission. Options that are available to the commission. So upon receipt of what we call an objection, we understand that the options that are available to who? To the commissioner. Are we together? So if it comes with an objection, a commissioner has a number of things that it can do. So I will not write them, but just talk about them altogether. So it can agree only and vacate the assessment altogether. Are we together? In case there's no dispute. Based on the proof, how you're objecting and the documentation that you furnished, the commissioner can agree and it vacates the dispute. And the dispute is solved. To my Lawana. Based on the objection, the commissioner can agree wholly or fully and it vacates what's called vacate, and the disputes basically be resolved. The second option that is available to the commissioner is that a commissioner can partially agree with the taxpayer and amend the assessment accordingly. It says XYZ, I agree, but WXDD, I do not agree. That is what we call partial agreement. Then the third option that can happen basically on this assessment is totally disagree with the taxpayer and confirm and issue what we call a confirming notice. Totally disagree with the taxpayer and issues what we call a confirming notice. Mwalimu begs to stop at that point. I will go and go. I know I love what I do, so I can go and go without stopping. But I beg to stop because I can go. I can continue, but I don't want to interfere with you people. Let us close it there. And you just say, Victor, give me a call. After that, we talk and see what we will do. Thank you so much. Yes. Thank you so much. It's by the grace of God. We are serving. We are not doing anything. This is responsibility to God. Chepchumba, do you know it's responsibility to God? We are serving God when we are teaching. Yes. So we must make sure, we must be very careful. We can be cursed or we can be blessed. So I hope we are getting blessed. Thank you so much. We'll close it there. Have a great morning.